Everybody, quick disclosure before we get into the show. Although our guests this week are managing partners of a registered investment advisor, nothing in this podcast should be considered an offer of Multicoin's investment advisory services or should otherwise be confused for investment, tax, legal, or other financial advice.
We are going to need an alternative, and that alternative is going to be internet native money. Not industrial age native money, but internet native money. And the asset that will become internet native money is the asset that the most people own and use. That's the metric that matters.
This episode is brought to you by DAS London, Blockworks' #1 institutional crypto conference where all the top institutions and people in crypto are going to be this March in London, what's becoming maybe the crypto hub of the world. I have a link in the show notes where you can learn more and also a discount code that will get you 20% off. So click the link, find out more, and I'll see you there. What's up, everybody? Welcome to another episode of Lightspeed. Today, we are joined by Tushar Jain, who's the co-founder of Multicoin Capital with Kyle Samani. Tushar, welcome to the show.
Hey, Garrett. Thanks. It's great to be here.
Yeah, pumped to have you on. One thing that I think would be really interesting to hear from you is just as being one of the first and kind of the lead investors in Solana and really riding that wave up. And then obviously going into December with the FTX implosion. And then now, I would say with the community and also the applications building on top and the adoption of the SVM, it's almost now getting more recognition than it did in the past. Just in the past, it was all about price. Now it's actually about the tech. So I'm curious, how has that been seeing this adoption now after what was this wild ride?
Yeah, I'll start with a story. When we started Multicoin in 2017, we picked the Phoenix as our logo. And the reason for that was very deliberate. We saw that this industry is incredibly cyclical and incredibly volatile. And most importantly, we knew that rebirth happens in fire and it's painful. It's not a smooth, easy ride all the way around. So we expected this type of cyclicality. Obviously, look, you can't forecast the emotions that come along with it. Right? That is just the human part of everyone. But intellectually, we knew that we were going to have this type of cyclicality. And this volatility is, it's actually an asset to the industry, I think. There's a real value to kind of it's almost like bulking and cutting, right? Like you bulk up number of projects, you get a bunch of people in, and then you have to trim the fat. If you're always bulking, you're just going to end up really fat and bloated, and it's gross.
Like myself.
But if you're always cutting, nothing ever happens. So you need those things in balance. With regards to the most recent cycle for Solana, going through 2021 and then, the bear market in latter half of 22 to now, I would say we have seen this play out, and Solana survived the existential risk, which was the community falling apart. This is very similar to what happened in ETH in 2018, 2019. Right? The existential risk at that time was the community of devs falls apart. People say, what were we doing here anyway? Why are we here? And you lose that developer ecosystem, and that becomes impossible to recover from. But that clearly did not happen. And so, I think the thesis is still on track and it's playing out, and, we're excited to watch it continue to compound and grow.
So talking about stories, I do want to maybe zoom out and go back to when you guys first heard about Solana and, when you were maybe doing your due diligence and forming a thesis around how you think the Solana thing will play out in the context of the different architectures at that time. A lot of the things, L2s didn't really have traction at that time. If they certainly weren't what they are today. And so I'm curious, as you maybe look back to that point, what was your kind of thesis on Solana, and has that kind of evolved over time?
The thesis has somewhat evolved, but the crux of it is the same. The crux of it is we think composability really matters. We think that developer experience is critical, and developers are not going to want to deal with the complexity of additional layers, L2s and bridges, and now we're talking about L3s, and it's hard, right? And look, building a business is already really hard. There's too much internal thinking within our industry, I think, of like, oh, well, how are you going to build this, and where's it going to be deployed? But what really matters is getting users and giving them something that they want, that something or people are willing to pay for, and that's what all of your energy as a founder needs to be focused on, not on, okay, well, how do I make sure this is a smooth experience between these 4 different heterogeneous L2s with 3 different bridges connecting them, and whatever the combinatorial number of things that can happen in between that is. We were just like, reduce complexity. We think an integrated system does that. And then what we really liked was Anatoly always had the North Star of, we want to have the lowest cost transactions. That, I think, was critical, right? Other chains were looking at, actually, we want to have higher costs because that helps our revenue for the ecosystem, and it creates burn, and all this other stuff. And all I ever heard from Anatoly was, we will have the cheapest transactions because we want the most people to use this thing, and that's what I care about more than anything else. And that message really resonated with me.
Mm-hmm. Mm-hmm. So I'm just going to play the other side here just to hear your takes on this. So while, I believe that obviously anybody from my Twitter will see that, but there is a common criticism that, maybe that's not so great for the underlying assets. And as a result, maybe that affects the security of the network, which, economic security, some people think it's a meme, some people think it's legit. But I'm curious how you think about the transactions being super cheap in the context of the native coin and value accrual.
It's a good question. I think it comes down to a question of time horizon, really. And let me zoom out and give you kind of the big picture of where I think Solana or another L1 can end up. And then I'll back into that using kind of a sum of the parts valuation methodology. So the big picture to me, the North Star to me as an investor, has always been, I think we are going to have an L1 token that will be global, non-sovereign money, non-fiat money. And this is the original vision for Bitcoin, though I think Bitcoin's design is flawed in many ways. I think this vision is really powerful. And when you look at the fiscal debt situation of all the countries and the monetary situation, you don't need to be some sophisticated macroeconomic analyst to understand it's fucked. This is not going to just turn around and it's not going to be fairies and unicorns fixing our problems. The situation is fucked. And so we're going to need an alternative, and that alternative is going to be internet native money. Not industrial age native money, but internet native money. And I think the asset that will become internet native money is the asset that the most people own and use. That's the metric that matters, right? Look at all the other assets in the world. How many people in the world do you think own US equities? Maybe 500 million-ish? Might be 1 billion if you're, being really generous and counting a lot. Maybe there's some double counting. How many people own, fixed income? Probably less than that. How many people own real estate? Right? Probably, a couple billion. Most people don't own their real estate. I think that these tokens can become the most widely held asset in human civilization across the entire world. And that's kind of the really guiding North Star vision. So how do we get there? Right? I think there needs to be kind of like a phased approach to how this value works, right? And I think the first and most immediate phase is kind of what the ETH people have come across, and other chains as well, is, hey, let's have a narrative around token burning and scarcity. right? Bitcoin kind of came up with the scarcity meme, and then ETH kind of came up with, well, actually, the token is deflationary. And that creates some risk appetite amongst investors for that asset in the short term, right? Then I think in the medium term, what I'm most excited about is MEV. I've presented on this before, videos up on our website at multicoin.capital from last year's summit, 2022's summit, where I talked about MEV as a framework for valuing asset ledgers like Solana. Basically, you can do a discounted cash flow valuation for all the future MEV on the network, and that gives you a floor on the value for that L1 today. And then, that's that medium term piece. And then I think in the long run, it's this global non-fiat money because most people own this asset, and that's where you get the truly incredible outcomes.
Yeah, I really like that answer. Obviously, it's very nuanced, and a lot of the value of money is a meme, which has to do with adoption is a big part of that. I am curious, have your viewpoints changed since you first got into the space on like tokens of individual projects that are building on top of this L1? Like I think at one point people thought these tokens would be a currency and often used throughout the app and maybe even outside of the application itself. But I feel like that meme in some ways is kind of fallen apart, and it seems more like something like Sol or ETH would be used in these applications more than the token itself. And maybe those tokens would derive values from cash flows, so it'd be purely a DCF, but it would lack that sense of monetary premium you might get from a meme. I'm curious what you think about that.
Yeah, that's a good question. I think the monetary premium will accrue almost entirely to the L1 asset and not to anything built on top of the L1. I think if you're building on top of an L1, you have to find alternative ways to capture value for your protocol. And that's why we are really, really picky when it comes to investing in applications. Even if we see great founder, great market, if the value capture is not clear, we'll be very supportive from the sidelines. We'll be rooting for you, but it makes it not. It doesn't fit our investment profile.
Yeah, so I did. I just have some questions around that. A lot of founders, I would say, listen to this show, and so one thing I'm curious about, and we also asked this to Joel from Placeholder, and he said he asks himself this question all the time, which is like, okay, when do you actually do an application investment when the underlying token is more liquid and has less risk, right? So I guess that's kind of the question here, which is how do you what are the qualities of something built on top of the L1 that would make it more investable for a VC? What are some properties it should have?
We look for a handful of things. One of the things we look for is unforkable state. One of our main theses is that blockchains and kind of the whole crypto ecosystem is going to be really powerful for margin destruction or margin compression because everything is open source, everything is permissionless, right? At least ideally. I know there's still some things that are closed source, but I'm an open source maxi, and I think that's the direction that things are going. So if everything is open source and everything is permissionless, you cannot just extract rent. You can't extract a fee on top of something that someone else can just go fork and create a free version of. And so what we look for there is unforkable state, something off chain that can't be forked away. Right? This would be, this would fit DePIN, for example, right? We've been big investors in Helium and HiveMapper. There's physical hardware there that isn't going to be forked away. No one's flashing new firmware onto their dash cam for like the next network, right? Like that, it's just not technically feasible for the vast majority of people. So there's some unforkable state. The relationships with real world customers is unforkable state. And then for purely on-chain businesses that do not have this type of unforkable state, we look for some sort of risk that is being managed by the token or by the protocol. An example would be, a borrow-lend market or an over-collateralized stablecoin, where if that protocol becomes under collateralized, then the native token is used to plug the gap, and it's sold off in that crisis moment to plug the gap. And so it's basically acting as a quasi insurance fund. And insurance is one of the few businesses that is unlikely to see margin compression due to this type of technology. But if you're offering kind of a non-risk bearing product that doesn't have anything off chain tied into it, I think value capture is much harder to accomplish. It's not impossible, and I'm not a fan of black and white rules, but in my experience, it's been much harder to have a sustainable plan there.
I do think DePIN is interesting because you have real world assets that you can actually establish like economies of scale and a moat. Like you said, it's very hard to switch. I did ask a buy when we were talking about Helium. Could you eventually get to the point where it's almost like Uber and Lyft, where you can provide for different networks depending on who's offering a higher stake? I think that could be interesting, for example, because, just like today, you might be a driver and you look to see who's offering the higher rate for me right now. So maybe over time, a little bit of that moat could go down. But I am just curious to maybe touch on DePIN a little bit more because I know it's something that's really attracted you. And when you first started in Solana, it was very much NASDAQ on chain. But I feel like now there's multiple narratives, including NFTs. But I think DePIN is maybe the fastest growing narrative right now. So what is it that makes you so attractive to it? And I think if you've touched on it before, I think the onboarding and getting people on chain and getting paid on chain is a big part of it. So I'd love for you to talk about that.
Yeah, absolutely. I want to address your point, though, about kind of having an Uber Lyft type situation for something like Helium. I think you could theoretically see that happening, but I find it to be an unlikely equilibrium state. And the reason for that is if the rewards are higher on network A versus network B, and you can choose freely between them, everyone switches to network A, right, on the supply side, because why wouldn't you? And then network B loses all their customers. And so how will network B ever be able to have higher rewards than network A ever again? Now, obviously, this isn't something that happens overnight. It takes some period of time to play out. But I think the stable equilibrium is really everyone coalesces to one. And the key thing here is protocols are not subject to this kind of antitrust action that broke up other natural network effect businesses like telecom, a few decades ago. That's a natural monopoly, right? There's without government intervention, there is no reason to have two telecom networks. One is the most efficient, right? Because it's just the cheapest to only have one set of that infrastructure. And so given that protocols are not subject to that, that's why we don't have multiple email protocols or multiple, HTTPS, right? Like protocols kind of come back to just one big winner. And that's what I think will happen with these DePIN protocols, because what they're doing at the end of the day is just coordinating people in a huge variety of circumstances. And that coordination technology is a natural monopoly. And I also don't see how an antitrust regulator breaks that up, at least with the tools that exist today.
Yeah, one more question on that, because I think Abai was also talking about with Helium. It's like, yes, we have, say, like Helium Mobile, but you can have multiple products built on top of this. And like we have 5G, but we also might go into Wi-Fi, and we have IoT. And at that point, you start seeing this horizontal integration. So I'm just curious, like, do you think these markets in DePIN will stay verticalized, or do you think we truly will see these like just expand horizontally over time?
I'm not sure. I don't think we have the data yet. I can make the case for both. Right, the case for vertical specialties is pretty clear. Focus is critical to building good products, and vertically specialized companies can focus better. The case for horizontal consolidation is also pretty clear, and just there are network effects to the utility of a protocol. There's also network effects on the capital market side, and if you see more capital flow into the conglomerate just because it's easier to underwrite for capital markets, well, then that conglomerate can be the one that's offering, the best rewards for suppliers or the best prices for users and can end up winning. So I can see both of these things happening. If you put a gun to my head and made me choose, I would guess verticalization wins first, and then conglomerates come in later and consolidate some of these vertically specialized players as the products become more ossified and the product focus becomes less of the key differentiating factor.
That reminds me, when we speak of vertical integration, you guys wrote, I'm not sure if it was Kyle, I think it was Kyle, about kind of the vertical specialization of NFT marketplaces. And I thought that was a really good piece because it took kind of this model of maybe like aggregators like a Magic Eden, and then it turned it, because that's more of a horizontal play, and then it said, okay, well, NFT collections should actually have their own marketplaces, provide their own experiences and capture value that way. And then maybe there's kind of protocol level aggregators to make sure that users can discover these different players. I still think that is a much better solution than what exists today, but it doesn't seem like the market has really reflected that. What do you think? Why do you think that is? Like, what has your guys' views on that evolved?
I think the thesis that Kyle published is still valid. I don't think we've gotten any information to invalidate it, but obviously the market has not evolved in that direction either. Now, the period since he published that post to now has been a pretty brutal bear market that leads to people not necessarily trying new things. Also, some of the bigger consolidated players had the most capital, and that can be a very impactful factor in the depths of a bear market. So, to summarize, I would just say data so far is inconclusive. I don't think the data over the past year or so on the verticalization or horizontal NFT marketplaces is actually that useful, because there's just not enough people using this stuff yet, right? Like it doesn't matter what the 10,000 or 100,000 people that use this stuff today think or do. Like that actually doesn't matter. What matters is, what do the next 10 million people think, and what products do they want to use? So I would not over extrapolate.
So I am interested because you guys are very deep into like either like very deep tech, like the L1s or like Filecoin, etc. But then also like DePIN and stuff like that. And so NFTs kind of just feel like that meme to me, where it's like a bunch of serious people and there's kind of like the McDonald's like clown guy, or the bird, I forget the name. So like NFTs just feel like a weird segment, or like a different differentiated vertical. How do you guys think about NFTs just as an entire asset class actually yourself personally, but also at Multicoin?
There's a diversity of views across the investment team. So I can't say that we all agree on this. We disagree, on a variety of things. For me, what I'm excited about NFTs is utility around NFTs. I'm not an art NFT person. I get that other people care about that stuff, and it's just not for me. But what I do think is useful is using NFTs for ticketing, or using NFTs to give people proof of something. I think soul-bound tokens are really interesting ways to give people identifiers for something they've done, and that's likely to be represented as an NFT somehow. And that's what I'm most excited about when it comes to using this technology, which is why like compressed NFTs makes a lot of sense to me. Do you need compressed NFTs for a 10,000 PFP collection? Like, no. That's fine, especially if those things are going to be worth 6 figures each, right? Like, go pay the $50 transaction fees on ETH1. Like, it doesn't matter, right? But when you want every single ticket for every single major sports event across all the different sports in the world to be an NFT, well, you're going to need compressed NFTs. This is not going to work otherwise. right? So I'm specifically interested in the really inexpensive minting and transaction costs to make stuff useful. And personally, I don't invest in the kind of art markets, though others on our team are more interested in that stuff.
A little bit tangential, but I know I've heard you say multiple times, you need to be contrarian and you need to be right. Like that's your job as an investor, right? And it's not your job to be an index fund. I'm curious, what is something right now, and often when you refer to that, you were talking about L2s and not just L2s themselves, but L2s that use the EVM, right? So non-parallelized execution environments. I'm curious, what else though exists today that maybe you feel that you're contrarian on, the rest of the ecosystem is not looking at? And that could even be something that you are just like, this is completely wrong, or this is something I think is going to be right or proven right in the next few years?
I think people really underestimate DePIN. I think it's going to be the thing for kicking off the next cycle. And the reason for it is when you look at historical crypto bull cycles, they seem to be catalyzed by a new method of token distribution. Let me give you some data points, right? 2013, 2014 bull cycle, I think, was catalyzed by the proliferation of proof of work forks. This is when things like Litecoin and such were created because Bitcoin was now stable, had a few years of history, and now let's go create a bunch more, right? And that created a lot of excitement, and we saw a bull market. Then you have the 2017 bull market created by ICOs, right? You had those first few ICOs; they went, very well for the people who participated in them. And that was a new method of token distribution. You don't need to mine the tokens; you can do an ICO, right? Then that ended, and in 2019 we saw kind of a mini bull market at the beginning of the year, which was IDOs, doing the same thing as an ICO but on an exchange with KYC and such. So slightly safer way to. I would even say that's an echo of the ICO bull market. Then 2020 we saw a new method of token distribution, which was liquidity mining. Right, I think liquidity mining really drove that part of the cycle, and it was, hey, do something useful with your assets, and we'll give you more assets in exchange for doing that. Then 2021, I think, was driven by NFTs and the cultural influence of NFTs. You saw all these big artists or athletes, and all these other cultural icons adopt NFTs and start talking about them. And that brought in a whole new set of people into the industry. And so what I spend a lot of time thinking about is what will be the next thing that does that. And in my mind, DePIN is the best position to do it. Alongside, I would say, stablecoins and payments. Stablecoins and payments, I think, are also extremely undervalued right now. Even though everyone thinks that they're excited about stablecoins, it's kind of like in 2012, what was the most underhyped thing in all of technology was probably mobile, and that was in 2012 when mobile was like the number one thing on every tech investor's list. But it was still underhyped. I think people still underestimated how powerful it was going to be, and so I think the same thing is true for stablecoin payments. I think it's the number one thing on every crypto investor's list right now, and it's still underhyped.
Yeah, that's well put. It's a good, interesting framework about kind of token distribution mechanisms, maybe being a catalyst for past cycles. So, which kind of leads me to segue into the state of Solana and how, generally speaking, Solana doesn't really have many tokens. I mean, with the exception of DePIN. It seems that Solana has fallen behind on the TVL side of things. And part of this could be attributed to the fact that most of the DeFi protocols on Solana don't have tokens. I'm curious kind of on your takes on first of all, what do you think about the state of TVL and kind of using that as a comparison between chains? But then two, why is Solana DeFi kind of, I mean, it seems to have been picking up, and obviously Jito Sol is going up right now as well. But I am curious, what is the discrepancy there?
Yeah, I think TVL is not only a useless metric, it's an actively harmful metric to focus on. Actively harmful because it gives you a false sense of precision on a metric that can be trivially gamed. So TVL in a lot of places is double, triple, quadruple counted. right? You deposit into some smart contract, you get this receipt token, you deposit that into the next contract, and so on and so forth, and you can daisy chain these things together. TVL doesn't take liquidity of the assets into account. So, you can create some very low float, high market cap thing and point to the high TVL. And so it gives people a sense of false precision that is actively harmful. And this is a crusade that I'm on, is like, please stop looking at TVL as a useful metric if you're at all a serious investor, because you are just lying to yourself about it being a metric. The thing is, investors love looking at metrics, right? Like they want to look at data. They want to feel like they're data oriented. But if you're going to do that, make sure you pick the metric that matters, not just the one that's easiest. TVL has become this meme because it's the easiest thing to measure. It's trivial, right? Like you just run a query and like, here's your number. But you are just lying to yourself if you think TVL predicts anything. I think the only metric that really matters is people building net new stuff and then number of users interacting with that stuff. Like that's it. I think everything else is a derivative of that. If your chain has people getting assets on that chain, if they're doing things, whether they're mapping for Hivemapper or providing their GPU for render, or using USDC payments, or so on and so forth, DeFi will become a thing there. Not because you willed it into existence or because you had a high TVL, because it's the cheapest, most convenient thing to do. Right? I just want to trade this thing, and like DeFi is easier because I don't have to wait, to create an account and all this stuff with CeFi that gets complicated. Right? And so I think focusing on TVL is kind of putting the cart before the horse. And so, yeah, I'm on a crusade to get people to stop using it. I talk to other investors about this all the time.
Yeah. TVL is a bit like assets under management, AUM. So like it is a good filter. Say you're looking for a job and you want to work at a private equity fund or a VC fund, and you see how large their recent fund was. It's like, okay, this fund's probably pretty good. Like I should check them out. So I see from that point of view, like why it's useful for new users coming to your chain. Quick break from the show to tell you about DAS London. Look, I don't really give investment advice, but I'm going to do it here. This investment gives you a real world experience in London. Yep, a trip to London. You're going to meet some of the smartest institutions, people, and builders in the space. Third is you actually get to listen to these people as well, because there's going to be over 60 speakers at this event. And fourth, most importantly, of course, we get to hang out. I'm talking about DAS London, which is Blockworks' biggest and best institutional conference that's happening this March in London. The big institutions are starting to realize that crypto is here to stay, and they're actually leaning into the space. From BlackRock to Visa, we're seeing it all. It's a 2-day in-person event. Like I said, over 60 speakers. It's a killer lineup. But more than that, like what's most important to me is the people you get to network with and meet. Like you might collaborate with these people, whether you're a project or maybe you're looking to work in the space. You might work for one of these people or just learn from them. Like it's really great to meet these people, and this gets everyone under one roof. So I'm a huge fan of this conference. I'm going to be there. Check out the show notes. I provided a link where you can learn more, and also a 20% discount code. Yeah, 20% off the ticket. These tickets do go up every single month, so that's why I would sign up now. The code is Lightspeed20. That's Lightspeed20 again. That's in the show notes. Make sure to use it so they know I sent you, and you'll get that discount. All right, I hope to see you there. Now, let's get back to the show. I'm curious from Solana's perspective, do you think Solana's future could be a consumer, like the consumer chain? I know that's a narrative some people are kind of leaning into. It's like there is DeFi in Solana, and it's cheaper and faster, and you have unique things like clubs that you can't do in Ethereum. And there's a reason why that would attract professional investors, and you would have NASDAQ on chain. But there's also another thought. It's like Solana is the one place where you can be adopted in emerging markets. You can have DePIN because of low fees, and you can have these smaller payouts. You don't need, 10 whales to control your DeFi ecosystem. Instead, you could have, 10,000, a million, a billion people, but each person adds a lot less value than you might say like an average user would in the Ethereum ecosystem. So I'm just curious what you think about the consumer narrative chain for Solana.
I think that is the ultimate narrative. Coming back to the time horizons and, what I was talking about before about the 3 ways that a layer 1 captures value, right? You have kind of this commodity aspect of burning something. You have the fee burn and create some sort of scarcity, right? Then you have this cash flow MEV aspect. And then you have the money aspect of this is the thing that the most people in the world own. It is the most widely held asset in the world. And I think that requires you to be the consumer chain, is most people in the world own this asset. And in order to do that, what's the most important thing that it's cheap. That's the most important thing. Like, in my mind, Solana is for the poors, right? Like, I love that meme. I love that meme because, hey, the reality is, like, most people don't want to spend a bunch of money. They want to spend less money, right? And so being cheap, I think, is the key thing that matters. And Solana is at a place where an app can even subsidize the transaction costs for all their users. Try doing that on an ETH2. Like, you better have a ton of VC money.
I do. I did have a follow up on the TVL kind of crusade, as Tushar put it. Are there any? So I mean, it's obviously it's obvious you guys think more first principles and less mimetic than other, let's say, people in the space. So I am curious, when you evaluate chains or even protocols and you use certain metrics, are there any other metrics that you think are kind of like red herrings and just shouldn't be used? And what would you prefer to use? Like, for example, some people think Nakamoto coefficient is kind of stupid. Some people think it's like the holy grail. Some people think TPS is useful, but some people think it's, well, maybe just represents capacity or sometimes demand, depending on what chain you use. So just how do you approach metrics, and are there any you prefer over others or strongly dislike other than TVL?
As a meta point, I think the earlier stage an industry is, the more qualitative investors should be. And the later stage an industry is, the more quantitative they should be. You're evaluating, publicly traded Fortune 500 companies, you better look at the numbers, right? You better understand exactly how each of these inputs changes your DCF, and understand what is the value of a stock of Apple, or a share in Microsoft, or so on and so forth, right? Because those are really mature. When it comes to crypto, I think it's very immature. And I think borrowing that quantitative reasoning does not do investors a lot of service in an early stage industry. So what we look at are more qualitative measures, right? What I think matters is people building unique things. Or another way to say that is like unique intellectual capital on that chain or in that ecosystem. People building things there that they wouldn't or couldn't build elsewhere. And then the only quantitative measure that I'm interested in, though you can't get an accurate count of this, is number of unique people using that chain. And to answer the other part of your question of what metrics do I hate the daily active addresses metric because it's gamed, right? Everyone games that. It's just too easy to game it. I hate any of these metrics that can be gamed, right? You have zero slippage trading on some protocol with, oh, well, that volume number is not going to be real, right? Because show me the incentives and I'll show you the outcomes. If the incentive is to game that metric, I promise you someone's gaming that metric. It's inevitable in a competitive industry that happens. So I hate those metrics that can be gamed. TVL, on-chain trading volume, often it's less gamed than TVL, but it's still gamed to a real extent. Daily active addresses is totally useless gamed metric. Nakamoto coefficient, I think, is kind of useful, but also, like, how many people are actually running those validators? Like, how do you know, right? Like, you don't actually know that thing, right? So you can think to yourself that you know it, but you don't actually know it. So that's why we focus on more of the qualitative aspects.
Tushar, I know you look at data and analytics at your firm, but I am curious. So, like in a traditional VC firm or private equity firm, your analysts are like in Excel all day doing financial models. Is that something you think even applies to crypto right now? Like, is that what you would look at for an investment at all? Or do you think it's almost a meme when people are making financial models for projects right now?
I look for financial models because I want to see how much the founder thinks they're going to need to spend to accomplish the milestones that they have set for themselves. And I want to see a rigorous budgeting process because if you don't keep track of your money, like, one day you wake up, you're like, shit, like I have 2 months of runway left. Like, what do I do? Right. And that's a really terrible spot to be in. And so this is just the bare minimum for being a professional. right, and being a CEO is you have to have the budgeting down. So yes, I do want the Excel for that. And the later stage you are, and the more money you're spending, the more detail I want to see how you think about that. But that's kind of sort of the only thing that I'm looking at Excel models for. We are definitely more focused on the words than the numbers, right? Actually, funny story. I tell our investment team this all the time. I tell them your job is not to go find good investments. That's not what you're going to be judged on. Weird to say for an investment firm, I know, but your job is to go find the truth. It's to go develop a thesis, go think of a thought of how the world is going to evolve, and then we happen to monetize that through investing. And you don't think of new thoughts of how the world is going to evolve looking at an Excel model. That just doesn't really happen, right? So we don't spend a lot of time, trying to model out the future of how this thing might play out. We spend a lot of time trying to think those, contrarian thoughts around, how the market will evolve that other people don't expect or don't understand. And when we look at Excel, it's for check the box items like, is the CEO a professional and do they know what a budget is?
Yeah, I can confirm that as a CEO, you definitely have to have that financial model and the OpEx and ramp by customer and whatnot, just the people listening. But I really like that about chasing the truth as opposed to, maybe giving yourself the illusion of truth because you saw a few numbers. And I do want to maybe talk about numbers, go back to the qualitative metrics that you mentioned. I think the metric or not the metric, but the thing that you look for is how many new people are building like unique things on this thing. So, okay, question number one is, how do you look at hackathons? Do you look at Twitter? Do you look at just the amount of deals that come your way? What are some ways to gauge or just develop an instinct for that? And then number two, and sorry, it's kind of unrelated, but you did mention the Nakamoto coefficient, and like it's like, okay, maybe we don't know how many validators or like who's running these validators. I am curious on your thoughts, talk about metrics and kind of arbitrary stats. What do you think about the criticism of Solana not being decentralized due to hardware requirements?
All right, let's do those in order. So first question was around how do you see how many people are building unique things? There's no substitute for the hard work here. You have to look at every hackathon submission across every chain that you can. You have to go to the events. You have to talk to the people. You just have to show up, and it's hard. And sometimes in a bear market, it really sucks because you show up and the energy is shitty and everyone is sad, and you still have to show up, right? Like that's the only thing you can do. You can look at Twitter and get introductions from others. That's helpful too, but really there is no substitute for showing up, like none at all. So that's the most important thing in my mind. The second most important thing is build a brand such that people come to you and say like, hey, I'm building a new unique thing, right? That can help make things easier as well. But that's about it. I don't think you can build some automated process. I don't think this can be easily quantified. And it's not just number of people building unique things, right? Like each person has a unique quality of what they're building that you need to assess. That you just can't quantify this stuff. Like, how do you rate this project? Like, 8 out of 10. Like, it doesn't make sense. On what metric are you rating it? Okay, now let's move on to your second question about Nakamoto coefficient and decentralization and hardware requirements. First, I mean, no surprise to you, I think the hardware requirements point is just total like BS. The hardware is not that expensive. Like you don't need $100,000 of equipment to go run one of these nodes on Solana, and so yeah, you can't run it off your pocket watch or something, but that's fine, right? Like most people are not going to run their own nodes, and that is okay. Do you check the certification of every airplane you fly on or every elevator you go into? No, no one does that, right? Because you think, well, it has been checked. There are enough people checking it, and like everything is fine. Airplanes aren't falling out of the sky. Elevators aren't killing, tens of people every day, right? Like the system works without everyone independently verifying every single thing. So why does a blockchain need to be different? I don't understand that point of everyone needs to run their own node. So I just totally reject that line of thinking. I think that's too Bitcoin centric. And it sounds nice to be World War III proof, but like that's not what I'm excited to build for. Like I just don't want World War III to happen, right? But if like nukes start flying, like I don't care if the blockchain stays up. I'm worried about my family, right? Like that's about it. Now going back to the Nakamoto coefficient and useless quantified metrics, I don't think just the number of validators to get to the 33% threshold is the metric that matters, right? Like each one of these validators has specific qualities. Where are they located? If you have a Nakamoto coefficient of 1,000, but they're all located in New York City and subject to the New York State and NYDFS and U.S. government, all this stuff. How is that better than a Nakamoto coefficient of 5 spread out amongst 5 distrusting political entities around the world? No, like clearly not, right? And people run many validators, whether it's on Solana, whether it's on ETH, right? Like ETH has this what I think pretty ridiculous 32 ETH limit for a validator, and it just means that they have way more validators. But why? Like, what is that accomplishing? If you think that each one of those validators coordinates to like a unique person making decisions, like that's an utterly ridiculous thought based on everything that we know about how these systems work. So I don't think Nakamoto coefficient is a particularly valuable quantitative measure because one, it can be easily gamed. You spread your stake around to a bunch of different validators that you control. I think the thing that matters is knowing who are the operators. You actually have to go talk to them, right? Like go build relationship with the validators that you are staking to. Go to Breakpoint, go to these events, go talk to them and understand how many unique people there are. How do they make decisions? Hopefully there's some cognitive diversity in how they think about things. And there's some diversity in political jurisdictions.
Yeah, that's well said. And I do want to maybe pull a thread that you kind of hinted at there, which is, and I think you mentioned this earlier in the podcast, which is kind of Bitcoin. It doesn't seem like you have favorable views of Bitcoin's technical design, maybe, or just something about Bitcoin. It seems like you don't like. I did say the other day, I tweeted something about I don't think Bitcoin even has PMF, and I just don't like it, and I got yelled at pretty aggressively. So I am curious, how do you think about Bitcoin? Like, what is the role of Bitcoin in crypto?
I do think Bitcoin has PMF, and that PMF is digital gold. I'm just not. I don't know how durable that PMF is because I think Bitcoin's security budget is inherently flawed. And I think within the next 20 years, we see major reorgs on the Bitcoin blockchain because the Bitcoin denominated cost to attack the network gets cut in half every 4 years. And yes, you can say hash power is going up, but that's not the metric to look at. That's actually, talking about false quantification. That is the wrong thing to focus on. The thing to focus on is how much Bitcoin would it cost me to 51% attack the network. An example I'll give you is, you may remember, I think this was like 2019 when Binance was hacked for like 7,000 Bitcoin. It was a pretty significant hack. And they did not do this to their credit, but there was public contemplation. CZ tweeted about, maybe I should just publish the private key to the hacked account and see if some miner rolls it back. Because what are you giving up if you stop, trying to mine at the tip of the chain and you go back to before the hack happened? You're just giving up the accumulated block rewards and the fees during that period, right? And when it's 7,000 Bitcoin reward for going back. Well, the fees on Bitcoin are quite low, right? Like that's thousands of blocks of equivalent reward. So if only a dozen blocks have passed or so, it's economically rational for all of the miners to just go back to before that hack happened and then try to mine that block and use the private key that they have to give themselves the money. And that's only going to become easier and easier and easier as these halvings go on. So yeah, I think Bitcoin's security model is inherently flawed. I am grateful to Satoshi for the breakthroughs that created our industry. I think he's going to go down as one of the greatest computer scientists, economists, hybrid in history, and has created something truly amazing. But the first attempt at something is rarely ever right. And I think in this case, like the security budget is just broken, and the culture around Bitcoin is they will never be able to hard fork to fix it. They'll just deny the problem until it becomes unbearable.
Yeah, Tushar, I'm curious what you think about this theory. As you were talking about that, it's like Bitcoin, you said like the security budget maybe becomes a problem in 20 years or whatever, it might be. People are like, well, we'll figure something out by that point. But in a way, I see Bitcoin almost as like a issuance incentive for the whole crypto ecosystem. And by that, I mean, how big Bitcoin and how successful it's been in this product market fit it has right now has almost subsidized a lot of the crypto industry, in my opinion. Like, I don't think Ethereum or Solana would be where it is, obviously, today if Bitcoin just went to zero right now. And in some ways, it's like Bitcoin doing well, like this BlackRock Bitcoin ETF is what's kind of led in some ways probably to the pump of these other ecosystems and bringing attention back in. So it's almost interesting that like before Bitcoin runs into the problem that it may have with the security budget, the rest of crypto needs to figure out its own thing. And that the case that like Bitcoin went away or was just gold, it no longer has to be like the Schelling point for like, oh, are institutions going to come to crypto? Like, do you agree with that? Do you think Bitcoin is vital to the rest of the crypto ecosystem? Or do you think that's something maybe that's just vital today and then, the next couple of years, it won't be?
I think every day that passes, the crypto industry is less and less dependent on Bitcoin. Every single day. Monotonically, we have seen the dependence of the industry on Bitcoin decreasing as more people intellectually understand the value of the decentralized ledgers and the underlying technology, and we just get more people paying attention to the industry. I think Bitcoin kicked it off. I think it is still quite relevant. It's obviously the number one market cap asset in the industry, but I think it's less relevant today than it has been in the past. And I think it's going to be even less relevant next year and the year after that.
Yeah.
And so on.
Yeah. It's a terrible analogy. I just see that as like a declining issuance schedule that's going down. It's being less relevant over time, even though it really did matter at the beginning. And those transaction fees that you need to take over the issuance is really just the rest of the ecosystem showing off what crypto can really do.
I think Bitcoin serves as a cultural warning to other ecosystems. And I hope the Solana ecosystem hears this loud and clear. When you have the culture turn into maximalism of, we are right and everyone else is wrong, when you think that there's nothing left to learn from others and your product is perfect and cannot be changed, that way lies death and obsolescence. You have to be willing to evolve, right? I've seen this happen, obviously through Bitcoin's evolution. Bitcoin was a much more flexible culture back when I first, bought my first Bitcoin. Then, scary, I saw this happen with ETH, right? Like we've seen kind of that same tribalism and maximalism identity come into the ETH ecosystem. And ETH is what got me really excited about crypto in the first place, right? I just loved the techno optimism, to use Mark Andreessen's term, that Ethereum exhibited of like, we can build this amazing new future with this great technology. And it started out very open, and the ideas were evolving, and anyone could contribute. It felt like a real idea meritocracy, and then it became closed, and that's because people focused on the price. People, just like tribalism is a cancer to what I think will be the successful culture for a blockchain ecosystem. And I really hope, and I'm going to do everything that I can in whatever small role I can play to make sure that the Solana ecosystem does not fall into that same tribal trap. Otherwise, we'll just be here in a few years, sounding like a bunch of Bitcoin maxis about how we're the greatest and everything else is just a shitcoin.
Yeah, I think that was a really good point. One thing I'd like to touch on before we close up is I think you have this theory that as an investor, maybe as a company building the space, you have to polarize in the sense that apathy, being neutral, not making people feel something is like the worst place you can be, and that you need to have really strong conviction. Can you maybe explain why you think that, and also like why that is so crucial as an investor?
We live in the attention economy. The scarcest resource in the world isn't oil or gold or Bitcoin or whatever else. It is attention. That's what matters more than anything else. And you have to be able to get attention. The opposite of love is not hate, it's apathy. It's just people don't care. And so I think there are different amounts of polarization that you should endeavor to create based on your circumstances. And if you're a startup founder, at a seed round and no one's ever heard of you, man, I would go max polarization, right? Like, because the worst thing that happens is that no one cares. And if no one cares, like, you're not going to succeed if no one cares. You need people to care. You need to build a brand. You need to have people pay attention to you. But then as you get bigger and as you become more successful, you need to tone down the polarization. One of the things that I really respect about Anatoly, he's not actually polarizing, right? He's always been very respectful. He, I think, is one of the most respectful people on crypto Twitter. I've never seen him punch down, never seen him attack anyone, like literally ever. People say the most horrific things, and he still doesn't do that, right? And that's because he's at a different level than a new startup founder is, right? So it doesn't make sense for him to be polarizing. No, it drives people away, right? Same reason why if you are a political leader, right, like while you're running in your primary elections, probably worth it to be polarizing. When you're running in the general election, no, you don't want to be as polarizing because you want to attract as wide of a coalition as possible. And if you're running as an incumbent, in a re-election campaign, you want to be broadly appealing. So yeah, I do think polarization is important, but I would warn people, don't just turn that dial up to 11 and then leave it there forever, because that will not serve you.
Yeah, that is that is well put. As we wrap up, I do like, if you guys have watched the show before, I do like getting a little philosophical. And you did mention, I don't want to prepare for World War III. I want to build kind of like the future, like cool things. And you even mentioned the Techno Optimist Manifesto. I guess the question is, why are you here, right? Why are you investing in crypto? Why are you in this space? What is your North Star?
My North Star is freedom. Like that's what I care about the most. That's what got me interested in this space. Is I think that humans can build better, faster, more useful things if there is more freedom in the world to go build. I think there are a lot of constraints to building things, to advancing technology in the world, whether they are cultural constraints, legal constraints, economic constraints. And I think that crypto as a technology is knocking down a lot of those constraints, because what we have here is permissionless innovation. You don't need to go, get a license in every jurisdiction to go offer a crypto product there, right? Like, you might practically legally want to, but technically, just from a technology perspective, like, you don't need to on a censorship resistant chain, right? Like, email works in every country, regardless of whether, what country it is, right? Like, protocols just work everywhere. And so I think that type of freedom to coordinate across political borders, across economic borders, and across social constructs will create more wealth for humanity. And I think it just leads to a better quality of life for everyone.
Awesome. Garrett, I'm going to do a very quick rapid fire unless you have final questions.
Let's go for it.
All right. So just going to do super quick rapid fire today. Just, obviously try to keep your answers short, but if you think it warrants expanding, go ahead. Okay. So number one mistake startup founders make.
Oh, there's so many.
Top three.
I'll give you one from a fundraising perspective is tell me why now and tell me why why this thesis makes sense, right? Like, what is your unique insight and why does that matter right now and not, 5 years from now? I think the second biggest mistake that they make is they don't understand the value of urgency. You are default dead as a startup founder. You have to have a sense of urgency. You have to move your ass. You have to motivate the team to just keep moving. Yes, setback. Okay, let's go. Next thing. Let's go. Next. Let's go. Next. Quickly. And it's just so easy to waste time. And time is like the one thing you cannot waste. That's actually the thing that I look for the most in seed stage founders is like, how many times have you been pushed down to the ground and you got up again quickly? You just kept going. I think that matters a lot.
What is the vertical other than DePIN that you're most excited about?
Payments. I think payments are really interesting. I think especially technology that helps the world dollarize is interesting. I think that the dollar is going to increase dominance around the world because as bad as the fiscal and monetary situation of the US is, man, it's so much worse everywhere else. And so I think all those people are going to want dollars.
What is the most overrated metric other than TVL in crypto?
Oh, they're almost all overrated, but active addresses. I hate that metric.
For the modular thesis of blockchains, do you think app chains or L2s succeed in the long term?
It depends on how much composability matters. If composability doesn't really matter for your app, sure, go ahead, build an app chain, and hopefully the user experience for people going between different app chains can be figured out and be smooth. But if composability does matter, then app chains don't make a lot of sense, for those use cases. Just because like composability across bridges, theoretically possible, but man, my brain hurts thinking about all the moving pieces.
What are your thoughts on the state of governance and DAOs in crypto today?
It's pretty terrible, but then again, look at what's going on in the House of Representatives right now. Like, it's not clean anywhere. Turns out democracy, really fucking messy.
Do you think the US remains the center of tech in the context of crypto in the next 10 years?
Unless we do something incredibly stupid from a regulatory perspective, yes, but I'm enthused by the regulatory environment. I think we're past the worst of it. Actually, we had Paul Grewal, the chief legal officer of Coinbase, at our recent Multicoin Summit. The video's up on our website. And I would highly recommend listening to it. It's short, very punchy. He's a great speaker. And yeah, I think we're through the bottom in terms of overreaction to all of the learnings from 2022 that we were seeing. And hopefully we get some political leaders in there that actually understand this stuff. The good news is that there are a significant number of political leaders who understand this stuff. Now, some of them are being dishonest and taking the other side and twisting things for their political gain. But at the end of the day, I think truth wins. And I do still believe in American exceptionalism.
What is one piece of advice that startup founders don't hear often that you think they should hear more?
Look to invalidate things as quickly as possible. The worst thing that can happen to you is that you waste time and energy chasing down a theory that you have, and it turns out to be wrong 6 months later. Look for the invalidation as quickly as you can.
What is the number one piece of advice you would give to aspiring VCs looking to enter crypto?
The only way to outperform is be contrarian and be right.
What is, in your mind, the best way to cultivate a contrarian mindset?
Stop giving a shit what other people think. Like, really, you have to not care. You have another way to put it is be willing to be wrong in public. I think that's probably one of our greatest strengths. We've been wrong in public many times. It does not faze me. It doesn't bother me. I'm happy to be wrong in public again.
All right. I think that's a good way to end it.
Tushar, this has been really fun. Always enjoy your insight. Have always loved your content. I'll put all the links that we've talked about during the show because people need to check it out. It'll give you insight, not just on Solana, but like in crypto in general and where things might go next. So Tushar, excited to see you in Breakpoint. And thanks for joining today.
Awesome.
Sure.
Thanks, guys. I'll see you next week.
Yep. We'll see you next time. All right, I've got a little ending note here. First, thank you so much for listening to the full episode. If you really liked it, hit subscribe. But secondly, make sure you sign up for DAS. This is Blockworks' biggest institutional conference happening in London in March. I've included a link in the show notes and also a discount code. Get 20% off. Make sure to use Lightspeed 20 when you sign up. All right, I'll see you there, and I'll see you next time on Lightspeed.